Hello and welcome to the Buck Stops here. I'm Catherine Murray. Well, we have certainly just seen some record closes for the S&P 500 as well as the Dow. And the TSX has also been on a record rally. Energy shares in the energy sector, of course, have been leading the market, taking over from some of those FANG stocks, meaning Facebook, Amazon, as well as Microsoft, just to name a few. Of course, key to continuing to outperform in the market really is about stock selection. Remember, market record highs happen because of individual stock performance. So I thought it would be interesting to have our next guest come on and share his views in terms of how he runs a concentrated portfolio. In other words, very, very focused on stock picking, owning only a few number of stocks in the portfolio. Eric Jackson joins us now. He is the founder and president of EMJ Capital. Eric, great to be able to catch up with you and get your perspective on how you like to run money, because there's so many different types of styles out there: large cap, small cap, growth, value, but you run a concentrated portfolio. Can you just describe a little bit about what your approach is?
Sure. Thanks for having me on. It's really a portfolio of 25 max companies that I have on the long side. And these companies, I use the criteria of, are these the best, in my opinion, growth stocks over the next, say, 5 years? If they are, they should get a seat at the table. If they're not, or if someone else comes along that is more attractive than one of the existing 25 names that's already in the portfolio, that's usually when I have to make a switch, put somebody out, bring a new company in.
And so, when we think about all the stocks that are out there, the NASDAQ, as well as the S&P 500, the TSX, there are so many stocks to take a look at. And we're going to get to some of your stock-specific ideas in a moment. But maybe just describe a little bit about, what the past couple of years have been like in terms of some of the big winners, so we kind of get a bit of a feel in terms of, what kind of returns you're looking for. I mean, these are 5-10 baggers in some cases.
Sure. Yeah. That's definitely. I mean, ultimately, I'm looking for names that could ultimately be 100 baggers and that's over a 10-year, 20-year period. I mean, if there are certain names that come along, and there've only been a handful of these kinds of stocks in the history of the stock market. So Microsoft, Google, Apple, and such. But if you find one of these names, one of the things that surprised me, Catherine, is that like I got into Twilio in 2018 at $23. I thought that. The ultimate bull case for Twilio would be, this could get to $150, $180. It got to $150 in something like, 6 quarters. And I sold it thinking, well, the old adage, never be greedy, take a profit in hand type of thing. And the thing has continued on to almost $400 today. So I've been surprised. Some of these growth companies are really can just continue to compound. So, but Twilio has definitely been a big winner. Zoom, I was in Zoom early in 2019. HelloFresh early in 2019. Upstart has been a big winner for me over the past year. So that these are all kind of companies that a lot of people said, hey, this is too expensive when they came public. Oh, the stock market's crazy. They're giving these young companies nosebleed valuations. Turned out that Wall Street was pretty rational, because these high growth companies were had a high price to sales multiple for a reason, because they've continued to stay at a high growth pace.
And that is what's so difficult for some people, myself included a little bit. I have a tough time paying up on the valuation front in terms of times revenue or multiples times revenue or price to earnings, what have you. It's a difficult thing to do. You have to really understand the fundamentals. And I think almost sometimes, Eric, having a bigger picture thought process in terms of, where will this market really go? How big will it really get? Let me just ask you before we take a quick break, but take a look at Zoom as an example. Why did you get into Zoom and did you get out?
The reason why I got in was that in 2019 it IPO. And I would, go to Silicon Valley periodically and have coffee with folks before the pandemic. And, people who I've gotten to know over the past 20 years in technology, who I respect, and, always try to listen. Hey, what companies do you like? What are you interested in? And the name that I kept hearing about in the summer of 2019 was Zoom. It's really great. They're in a competitive market. There are a lot of people that do what they do, but they do it just a little bit better. And they've got a great CEO and so forth. So that's why I got in. And obviously, when the pandemic happened, the thing took off like a rocket ship. But there was a reason why it took off like a rocket ship, because it was really, really good at what it did, despite people saying, "Oh, Microsoft's going to put it out of business with Teams or Google or with Google Meet or what have you." Did I get out? Yes, I did get out. Probably too soon. Kind of after it had something like tripled in the wake of the pandemic last year.
And we are back with Eric Jackson. Eric, I just want to pick it up from where we left off, which is Zoom. Just to be clear, do you think it is still an investable story, even though we are coming out of this pandemic, we hope?
Yeah, I do, because everybody thinks of it as just the basic, video chat system, which we're using right now. But, they really have ambitions to get other meaningful adjacent products connected to the core business, which is still kind of the leader in what it does. So they have something called Zoom Phone. They want to kind of basically become a player in the contact center space. That was the whole reason why they went after their most recent acquisition, which ended up getting blocked. So they are still making really strong headway with in the enterprise space and selling kind of increased licenses, especially to larger enterprises. So it's not just a one pandemic pony, in my opinion. And so again, I don't own it now, but I do have a lot of confidence in management, and I think they're going to continue to surprise people going forward.
Understood. Let's talk about a couple of your newer ideas. Upstart is one. UPST is the ticker there. What's the company about? I don't think, in this, again, I think a lot of the names that you do take a look at, not everybody has heard of.
Sure. So they're sort of a new way of, you could think of a new approach to the FICO score and kind of assessing someone's credit worthiness. They've, instead of using FICO, there are a bunch of ex-Google folks who over the past 8 years have used computer models, AI and machine learning to generate what they think are more accurate predictions of someone's credit worthiness. Especially, you could think about like young students joining the workforce, where there's really not a lot of track record to go on. Their models are very strong in that context. So their business is matching consumers who are looking for loans to lenders who want to make loans, and their models give confidence to the lenders that they can offer these loans to folks at typically lower APRs than what those folks could get elsewhere. And those folks are attracted to Upstart as a matchmaker because of that as well. So they've only been working, in the US in the personal loan space, which is a pretty big space. But what's exciting about them is that things have gone so well, and the loans are really took off just in this past year compared to what was going on pre-pandemic. And they've just started to go into the auto loan space, which is 6 times the market size of the personal loan, which is like the credit card refinancing space. So, and you can imagine that down the road, they're going to get into mortgages, matchmaker, student loan matchmaker. So the credit market it's sort of it's a fintech approach to credit. They're the leader in my view. Have a great CEO, similar to Zoom, and so that's why I'm in it for the long term.
And their client base, though, I mean, they would be the banks, I assume. What's been the uptake in terms of their customers?
The initial lenders that they have been partnering with are typically smaller to mid-sized banks, and the reason why is because they don't have thousands and thousands of IT folks working for them, like a Chase or someone like that, who would say, "Oh, we don't need Upstart because we can just create these wacky models ourselves of credit worthiness." However, that is changing. So they're and the success that they've been having with the smaller mid-sized lenders is definitely garnering attention of the bigger folks. And so but even if they stayed in the small to medium-sized banks, especially in the U.S. where there's so many, there's a ton of opportunity there, and there are lots of banks looking for help so that they can make more loans.
Do they have a scalability issue, though, in terms of, it's always interesting when you see these great growth companies with a great product, but they actually don't have the salespeople to go out and knock on the doors. And at the end of the day, that's what business is still about.
Yeah, well, they're the reason why they've grown so quickly this year, and they're doing something like 300%, revenue growth in 2021 versus what they did in the pandemic 2020 year, is that something like 71% of the loans that they approve and then do the matchmaking are automated. So no person on Upstart's side is involved. So salespeople are needed, yes, in their business to get the banks on the platform.
Yeah.
But once that happens, there's not a lot of manual processing of the data to say, Eric gets approved and Catherine gets approved, but somebody else doesn't get approved or something like that. It's completely automated.
Okay. We're going to take a quick break. When we come back, and we've got a couple more questions on Upstart, and then we'll get to another stock pick. Eric, I just want to pick it up on Upstart. What are the biggest risks to you, and where does valuation fit into this growth company?
So the biggest risks are that, say one of their bigger partners were to drop them as a client. They started small, and so they have a couple of bank partners that are sizable in terms of the number of loans that they're processing. So if one of them were to suddenly, announce tomorrow they were dropping them in favor of somebody else, that would be a big problem. Another source of clients is they have a partnership with Credit Karma, which is now part of the company Intuit that owns like Quicken and all that stuff. And so, if suddenly Intuit was to decide that Credit Karma was not going to partner with Upstart anymore, that would be the other big risk facing them. So I think it's unlikely, but it's a smaller company, as like you said before. And so, yeah, if any, some sudden announcement like that happened, that would definitely hurt the stock.
And how much risk is there in the valuation these days?
Well, when they came public, I mean, one thing I really liked about them is that they were getting compared to people like, I don't know if you remember Lending Club from a few years ago, and that was supposed to be a new way of doing fintech with credit. And then they just completely bombed at that model, and they were trading at like sort of 1x revenues. And Upstart got it compared to them. So in my view, it was cheap. But now, things have changed. They've posted these blockbuster quarters 3 times in a row since IPOing. So the biggest risk with valuation is that they had a disappointing quarter or something, and now they're trading at something like 30 times next year's sales. However, I would say that it's all relative here, Catherine, and so if another popular fintech name that is really popular these days is Affirm, which is a sort of another take on the buy now, pay later trend, which Afterpay started. And so when you compare Upstart to those folks, they're actually in line or slightly less expensive in comparison. And the big thing that people are missing, I think, is that Upstart has had incredibly conservative guidance, and Wall Street, their estimates of what Upstart is going to do next year, to my mind, look incredibly conservative. So they're doing something like 300% revenue growth now. Wall Street thinks they're going to do 40% revenue growth next year. I just don't think it's going to slow down that quickly. So I think the likely scenario is they're going to surprise, raise estimates. Wall Street's going to like that, and so that's a long way of saying I don't think they're too stretched here on the valuation.
Okay. When a company beats analyst expectations on Wall Street or Bay Street, that's a very good thing. Stock normally performs quite well on the back of that. Speaking of stocks that have performed well, beating people's expectations is Bombardier. That's another stock that you like, Eric, and you bought it back in June of 2020. I did look at it, didn't buy it. So why do you like it? That's been a very volatile stock.
Sometimes, familiarity breeds contempt. I think Bombardier has created a lot of contempt, especially in the Canadian market, because it's been around for 20 years and it really has sort of bumbled along and disappointed lots of people many times. And I think many people get to the point where they say, no mas, I just can't deal with this company anymore. What's changed in the last 2 years? Well, the family has taken a step back. They used to run the company. They still control the company, but they did bring back someone who was the former CEO of Hydro-Quebec, and before that he worked at Bombardier, a guy named Eric Martel, 18 months ago or so. As CEO, he brought in a CFO who's like ex-CN Rail, so credible management. And the big thing is that they decided to slim down their operations. So they used to be in ski-doos and sea-doos, and they used to do the trains, like the subway trains in New York and all this. They've sold off all those businesses. They are now just a pure play private jet company. So when I got into the stock, I believe that they could muddle through. I was sort of thinking of the Las Vegas casinos coming out of the 2008 crisis, where the equity got killed because people thought that they wouldn't be able to pay off their debts. Las Vegas Sands dropped from like $80 to $3. And then when the world, realized that it did, things didn't end and they were going to kind of get their way through it, suddenly the stock bounced back. I think the same thing's going to play out with Bombardier. And they arguably have the kind of the best fleet of private jets in the world. And even post-pandemic, it turns out like lots of people want to fly private.
Right.
So I think they're in a very strong position.
Eric, it's great to be able to have more time to do some in-depth discussions surrounding the fundamentals of stock picks. So thank you for that. Speaking of which, I do want to just pick up quickly on Bombardier in terms of the stock has had a huge run, I think surpassing most people's expectations. Are you seeing institutional investors buy into the stock now, or have they been?
I don't know for sure. I do know that they rejoined the TSX Composite, 3 or 4 months ago. They had to kind of trade above $1 for a certain amount of time, and then they were approved. So obviously, when that happens, there is a lot of institutional buying that goes on kind of by default, because whether it's an ETF or a mutual fund, that all the members of the composite have to get purchased. So I do think that's happening, and obviously, I think it still is a show me story. So they're going to have earnings. Coming up shortly. Yeah. And I think they just need to continue to kind of tell the story. People need to hear it. People need to kind of, people will be ready to jump into it probably after the thing has surpassed $5 and they've missed the entire move from like 50 cents to $5. But that doesn't mean that it still can't be a great long-term return. Like when I think, 5 years out, if they're able to hit their 2025 revenue and EBITDA targets, which I think are very reasonable, I think this could be a $20 stock, down.
Okay. I just want to get to one more stock pick because people do love that, especially in this current market. We only have about 2 minutes, but 23andMe. Talk to us a little bit about that name.
Yeah, most people know the company. Maybe they've signed up for it and they've done the swab test and sent it away and got their genetic backgrounds from it. Most people might think of it only as sort of like a one and done direct to consumer story, because you just, you do the swab once and you get your report and that's it. And I think most people don't know that they IPO'd 6 months ago through a SPAC with Richard Branson. And what's exciting about the business, though, is that they're really building a kind of two businesses on top of it. They're building one sort of a telemedicine business where you're going to have like a long-term relationship with 23andMe, and they're going to keep you up to date when you take the swab on the latest research that's relevant for you. And you could even, get advice from medical staff, on, types of drugs that you might want to be, pursue or talk to your doctor about and so forth. So it's a much more kind of longer term relationship. And the second business, which is even more exciting, is that it's really a therapeutics business. And what I mean by that is that in 2018, they signed a partnership with GlaxoSmithKline to take all their genetic information that they have on 11 million customers who've opted into research. And they have a great head start from that database to figure out, why certain diseases take place with certain populations or certain people with certain genetic backgrounds. And so it basically helps speed up the drug development process. Their head start with their genetic lead, and it's really something that's totally unique. It's taken them 15 years to build, and so those businesses are much bigger businesses. So it's something like a $10 stock today. But again, like 5 years out, I mean, this could be something like $100 stock.
Are you surprised then that it doesn't have more interest in it?
Well, small. I mean, it was just like a few weeks ago a $3 billion market cap company, which sounds big, but it's actually nothing in the grand scheme of things. So, they really you have to fight for attention. A lot of SPACs, SPACs in general have a bad name now.
Yeah.
So I think when people hear it's a SPAC, they there must be something wrong with it, and I think you can miss a lot of good stories that way. So they're definitely one of the good ones.
Okay. Speaking of SPACs, and this is not a political question, I've got 20 seconds, but the SPAC that came out that will represent Donald Trump's or President Trump's media company, it's taken off. It's been unbelievable. Did you get in at any point, even a flip, even a trade?
No, that's not it didn't meet my 25 best growth ideas in the world criteria. I frankly didn't even know about it. And I mean, I heard about it on the day. It seems like every day there's some news. Yesterday there was some crypto stock that was up 80% or something like that.
Yeah.
So I typically don't traffic in those. And so missed out on the Trump trade.
Okay,
there.
I did too. Eric, we're going to leave it there. Great to see you. Thank you very much.
My pleasure. Thanks for having me.
Thank you. And thanks so much for watching. I hope you got a few good stock ideas, or at least understanding how to approach fundamental stock investing. That does it for me. We'll see you next time.